If you're looking for a reliable way to build or grow your retirement portfolio, then dividend investing might be just what you need. But with so many dividend stocks out there, how do you know which ones to pick? That's where the 8 rules of dividend investing come in. These rules are supported by academic research and the principles of some of the world's greatest investors, and they can help you determine what dividend stocks to buy and sell for rising portfolio income over time. So, whether you're a seasoned investor or just getting started, let's dive in and explore the 8 rules of dividend investing together. This is the Bullish Aristocrat. And in this channel I would like to share my investing journey, and give you all the tips and advice I wish I knew when I first started investing. So if you find that interesting, then please subscribe to the channel and like this video to help support us in reaching more people. Make sure to press the notification button to stay up to date with new videos that will be uploaded. The first rule of dividend investing is the quality rule. The quality rule suggests investing in reliable companies with consistent earnings growth and a strong balance sheet. This means looking for companies with a proven track record of generating stable revenues and earnings over time, which can provide a steady stream of income to investors. To assess a company's quality, you can examine its financial statements, credit rating, and dividend history. For example, you might look for companies with a history of increasing their dividends over time, as this is a sign of financial strength and commitment to shareholder value. Additionally, you might look for companies with a low debt-to-equity ratio and a healthy balance sheet, which indicates a strong financial foundation that can weather economic downturns. By following the quality rule, you can invest in companies with a high degree of certainty that they will continue to generate income for your portfolio over the long term. So, always make sure to assess the quality of a company before investing in its stock. The second rule of dividend investing is the value, or the bargain rule. The value rule suggests looking for undervalued stocks with the potential for long-term capital appreciation and income growth. This means looking for companies that are trading below their intrinsic value and have the potential to grow their dividends over time. To assess whether a stock is undervalued, you can use fundamental analysis tools such as the price-to-earnings (PE) ratio, price-to-book (PB) ratio, and dividend yield. For example, you might look for stocks with a low PE ratio compared to their peers, which suggests they may be undervalued. Additionally, you might look for stocks with a high dividend yield and a low payout ratio, which indicates that the company has room to grow its dividend in the future. By following the value rule, you can invest in undervalued stocks that have the potential to provide both capital appreciation and dividend growth over the long term. So, always make sure to assess the value of a company before investing in its stock. Let's continue with the third rule, which is the safety rule. The safety rule emphasizes investing in stocks that offer a high degree of safety and stability. This means looking for companies with low volatility, low risk of bankruptcy, and a strong competitive position in their industry. To assess a company's safety, you can look at its credit rating, cash flow, and earnings stability. For example, you might look for companies with a high credit rating, which suggests they have a low risk of defaulting on their debt. Additionally, you might look for companies with a stable cash flow and a history of steady earnings growth, which indicates a strong competitive position in their industry. By following the safety rule, you can invest in companies that are less likely to experience significant declines in share price, and that offer a lower risk of loss in your portfolio. So, always make sure to assess the safety of a company before investing in its stock. Next is the growth rule. The growth rule is all about investing in companies that have a track record of strong earnings growth and that are likely to continue growing in the future. To assess a company's growth potential, you can look at its revenue growth, earnings growth, and market share. For example, you might look for companies that are expanding into new markets or launching new products, which could drive future revenue and earnings growth. Additionally, you might look for companies with a history of strong earnings growth and a high return on equity, ROE, which indicates management's ability to generate profits from shareholder investments. By following the growth rule, you can invest in companies that have the potential to provide strong capital appreciation and dividend growth over the long term. Rule number 5 is the peace of mind rule. This rule emphasizes investing in stocks that offer a consistent and reliable stream of income. This means looking for companies with a long history of paying dividends, a stable payout ratio, and a history of increasing their dividends over time. For example, you might look for companies that have consistently paid and increased their dividends over the past 10 or 20 years, which indicates a stable and reliable income stream. Additionally, you might look for companies with a low payout ratio, which suggests that the company has room to grow its dividend in the future. By following the peace of mind rule, you can invest in stocks that provide a reliable income stream and a sense of stability in your portfolio. Next is rule number 6, and that is the ethical rule. The ethical rule emphasizes investing in companies that have a strong ethical track record and that align with your personal values. This means looking for companies that operate in an environmentally and socially responsible manner, and that prioritize good governance practices. For example, you might look for companies that have a strong record of environmental sustainability, social responsibility, and corporate governance. Additionally, you might look for companies that have policies in place to address issues such as labor practices, human rights, and community engagement. By following the ethical rule, you can invest in companies that align with your personal values and that you feel good about supporting. Let's move on to the seventh rule, which is the survival of the fittest rule. The survival of the fittest rule is all about finding companies that have a competitive edge in their industry and a sustainable business model. These companies have a greater chance of surviving and thriving in the long term, making them more likely to generate steady earnings and dividends. To identify such companies, you need to look for a few key factors. Firstly, you need to assess their competitive advantage. This could be a strong brand, unique intellectual property, or a large and loyal customer base. Additionally, you need to evaluate the company's track record of innovation and adaptability, which suggests it can navigate changing market conditions. By focusing on these factors and following the survival of the fittest rule, you can select companies that have a greater likelihood of generating steady earnings and dividends in the long run. Here's the eighth and final rule of dividend investing, the diversification rule. The diversification rule is all about spreading your investments across different stocks, sectors, and asset classes to reduce the overall risk in your portfolio and protect yourself from sudden market downturns. To follow the diversification rule, you need to make sure that your investments are not concentrated in a single stock or sector. This means investing in a range of stocks that have different levels of risk and returns, as well as different market exposures. Additionally, you might consider including non-stock assets in your portfolio, such as bonds, real estate, or commodities. These can help to further diversify your portfolio and protect against unexpected events. By following the diversification rule and diversifying your portfolio, you can reduce the overall risk in your investments and potentially generate more consistent returns over the long run. One of the most important rules to follow is the diversification rule. In fact, I believe it's so critical that I created a dedicated video on this topic. I highly recommend watching it after this video to gain a more in-depth understanding of how to apply diversification to your investing strategy. In conclusion, the 8 rules of dividend investing provide a comprehensive framework to help investors identify high-quality dividend stocks and build a well-diversified portfolio. By following these rules, investors can make more informed decisions and increase the chances of achieving consistent returns over the long term. These rules have been developed based on academic research and the experience of some of the world's most successful investors, making them a reliable guide for investors of all levels. Remember to apply these rules to your own investment strategy and regularly review your portfolio to ensure you are on track to achieve your financial goals. With a disciplined approach to dividend investing and a commitment to following these rules, you can build a solid foundation for a retirement portfolio that can generate great returns and provide financial security in the years ahead. Thank you so much for watching this video till the end. If you found it at all helpful, then please hit that like button and subscribe to the channel to always be up to date with new videos that will be posted weekly.